Hi, Greg Weldon here. I produced a global macro strategy report. It's a research piece, but also I'm the host of the Money Markets and New Age Investing podcast. We're here to preview season 2, episode 10 on the back of Jerome Powell's symposium speech in Jackson Hole. A major speech. More risk in labor market, less in inflation. We do not welcome further cooling in the labor market. The direction of travel is clear. So we know they're cutting, but the pace of rate cuts, plural, huge, will depend, of course, on the data. Well, this is what we said would be the best possible outcome in terms of being bearish on the dollar and bullish on the precious metals in particular, and bullish on the U.S. bond market, the 2-year and 5-year, in that you have a shift in the policy narrative to fighting from fighting inflation to protecting growth. All right, understanding labor market conditions require some dynamic in policy that is not restrictive. So a series of cuts has been telegraphed. All right, that's what we wanted to see. But at the same time, the bigger picture message is so important. Acquiescing to higher lows and generally higher rates of inflation, because inflation is not back to target. They have to make this move, though, because you have to protect growth, because if you don't have growth, you get a debt implosion. You cannot service the debt you have, the highest ever at the consumer, the highest ever at the government, the highest ever at the corporate level, without economic growth, and that is now at risk. So from that perspective, the question becomes, what is the appropriate policy rate? Well, neutral, with inflation at 2.5, would be 3.5-ish. That's already priced into the market. This could be a problem for the equity market going forward because the juice has already been squeezed out of the Fed funds, policy expectations dynamic. That leaves the dollar as key to all of what's coming next, not only from a U.S. monetary and fiscal policy perspective, not only from a U.S. political risk perspective, not only from a geopolitical risk perspective, but even most importantly, as it becomes parallel to the BRICS unit creation and yet to come selling of U.S. dollar assets, which will depress the dollar. Here is a couple charts just to show you what we're talking about. 3.25 is already the forward rate for the Fed funds for the end of next year. So you're pricing in some level of neutrality, if not tilting a little more towards easy. So the question is, between now and then, the economy comes off. Is that enough to hold the stock market up? That's why the dollar's in play. The dollar is looking at a major technical breakdown in a major pattern that goes all the way back to when you delinked it from gold in 1971. This is secular, big picture stuff to the max, why it's so important. The 5-year moving average at risk, the multi-year low here, which encompasses this entire ABC Fibonacci retracement of the entire dollar decline from the 1982 high to the 2008 low. This is technical analysis thing of beauty, as if we were in a textbook for a class on technical analysis. And you can see the degree of risk here and the vulnerability technically on a long-term basis in the dollar. Already, the purchasing power of the dollar, we know, is being eroded every single day. This is measured by an ounce of gold, and as well as anything else. And in that case, you're at a multi-decade low and about to go to an all-time low in the purchasing power of the U.S. dollar as measured in gold. You can see this already challenging the 2011 low. This is a great measure of the purchasing power of the U.S. currency. Now, this is not all necessarily bearish for stocks, because as the black line goes, that means the dollar's going lower and leading stocks. And in this case, a lower dollar is bullish for stocks. And a higher dollar, bearish for stocks. This is the most consistent and reliable pattern of correlation between two markets that exists anywhere. And in that case, this is a dynamic where you might get a reality check on the economy and the stock market. You might get some kind of, a lack of patience in the Fed if they don't move quickly enough or more aggressively enough. They need to cut 50 in September. They probably will. But is that going to be enough? And then you have 6 weeks till the next meeting, which isn't until the beginning of November. Then what? So that's a dangerous period for stocks. But they will play the dollar card. The dollar card will be played by foreigners too. And that's going to really boost stocks. But stocks not keeping pace with the debasement of the currency. What keeps pace? Gold. Here's the gold price adjusted Dow in black, Dow Jones Industrial Average versus the real Dow. Look at the difference. I mean, gold is the thing. Central banks know this. It's a tier one asset now. They're accumulating gold. You know, particularly the Chinese who are selling bonds, selling U.S. assets. The BRICS countries, a country like Brazil, 80% of their reserves are in dollars, need to sell those assets to participate in the BRICS currency. This is big time for gold. Get the full report, a one-time offer. Email me now. Follow me on Twitter at Weldon Live. Follow the podcast at at money_podcast. And follow me on YouTube at Gregory_Weldon. And check us out for episode 10 in season 2. The podcast coming up that's going to cover all of this in much greater detail.